Good evening. The Philippine banking industry weathered global financial crisis of 2008 to 2009 reasonably well owing to a number of factors. Very little exposure to the U.S. subprime markets banks' inherent resilience and strong balance sheets, conservative risk management and disclosure practices, and regulatory reform. The industry's income touched a high in 2007 before the crisis broke, and although it dipped the following year by 2009, even while the crisis was underway, Filipino banks registered a healthy performance all around in lending, capital adequacy, and profitability. The well-being of the industry is reflected in the 8.6 compounded annual growth in outstanding loans between 2006 and 2010. The outlook remains bright as young, educated, upwardly mobile Filipinos embrace banking products and services to add to the number of bankable households.
This presentation was a compilation of different clippings available in the web. The researcher would like to highlight that it is very important to be in the Philippines to conduct actual interviews with the bank's representative in collecting data in how they act in financial innovation and financial consolidation. For the final requirement for the subject BA 134 Economics and Finance, the presentation will focus on the banking industry. The Philippine banking system is compilation of several different types of banks. The General Banking Law of 2000 was passed in order to regulate both the operations and organization of banks in the Philippines. It also split the banks up into 7 different categories. The categories include universal banks, commercial banks, thrift and savings banks, rural banks, cooperative banks, Islamic banks, and other institutions as determined by the Monetary Board of the Bangko Sentral ng Pilipinas. As of 2004, there were 907 banks total within these categories. The Bangko Sentral ng Pilipinas is the central bank of the Philippines. It is located in Manila. It was created on July 3, 1993 and took over for the Central Bank of the Philippines with its creation. Bangko Sentral ng Pilipinas was given the power to maintain price stability as well as fiscal and administrative autonomy. The 907 banking institutions comprises the structure of financial system in the Philippines. There were 18 universal banks, 24 commercial banks, 89 from thrift banks or also known as savings bank. For rural banks, it's about 721. For cooperative banks, around 44. And 11 for quasi-banks. Let us now define the types of banks. Universal banks. Universal banks are the most powerful and have the broadest scope of services available. In addition to the authority to carry out services rendered by the 6 other categories of banks, they have the ability to practice the functions of an investment house. This includes underwriting. Universal banks can also invest in non-allied activities. In addition, they are allowed to own 100% of equity associated with thrift banks, rural banks, and allied activities. Thrift banks or savings banks. Thrift banks focus their services on smaller enterprises and individuals. There are a variety of banks that fall under this category, including savings and mortgage banks, and private development banks. Their main function is to accrue savings from customers and invest them. Additionally, they have the power to accept foreign currencies, issue domestic letters of credit, along with several other functions. Rural banks and cooperative banks. Both rural and cooperative banks hold the same authorities. These banks are most popular in rural areas. The purpose of these banks is to assist local farmers and merchants. They are authorized to provide loans, take savings deposits, offer negotiable order of withdrawable accounts, and act as a trustee over farmer and merchant estates. The only difference between rural and cooperative banks is ownership. Rural banks are privately owned, while cooperative banks are owned by cooperatives. This slide shows the market share of banks by class as per the record of Bangko Sentral ng Pilipinas. The figures are in billion pesos. The idea of the structure of the banking system in the Philippines was presented in the previous slides. We go now to the implications for the consolidations of banks in the Philippines. Let us first define the word consolidation in financial terms. As per Bangko Sentral ng Pilipinas definition, it is the union of two or more corporations into a single new corporation, called the consolidated corporation, all the constituent corporations thereby ceasing to exist as separate entities. The consolidated corporation shall thereupon and thereafter possess all the rights, privileges, immunities, franchises, and properties, and assume all the liabilities and obligations of each of the constituent corporations, in the same manner as if it had itself incurred such liabilities or obligation. On April 19, 2000, the Monetary Board approved the issuance of Circular Number 237, consolidating and clarifying all existing rules and regulations on mergers and consolidations of banks and other financial institutions. Section X112 for the Manual Regulations for Banks, and Section 4112Q of the Manual for Regulations for Non-Bank Financial Institutions. This was done to foster healthy competition between and among banks, bring about more and better financial services at lower costs, and promote stability and efficiency in the Philippine banking sector. In making available the additional incentives to mergers and consolidations, the Monetary Board also emphasized that even without incentives, the surviving or consolidated entity shall be viable. In line with the principle, the availment of these incentives, particularly the privilege of assets, re-evaluation and recognition of goodwill, shall be subject for the Bangko Sentral ng Pilipinas condition, and it is shown in this slide. As per the Bangko Sentral ng Pilipinas record on the publication available in their website, more than 20 banks have already availed of the new incentive package, 24 banks in line for applications involving for consolidations. Thus, these figures proving that the Philippine banking systems embracing the impact of Bangko Sentral ng Pilipinas regulations. On a report in Philippine Daily Inquirer dated May 16, 2012, Bangko Sentral ng Pilipinas ups the incentives for rural banks consolidation. Commercial and thrift banks are urged to acquire troubled rural banks, with regulators offering various incentives to potential white knights in a bid to end costly failures in the rural banking sector. The move to offer incentives to commercial and thrift banks came amid lack of takers from the rural banking industry. According also to the report in the Daily Inquirer, in this year alone, 4 rural banks have already been ordered closed by the Monetary Board of the Bangko Sentral ng Pilipinas and placed under receivership of the PDIC. These include First Provincial Bank of Tarlac, Rural Bank of Gigagit of Surigao del Norte, Rural Bank of Luna in La Union, and Rural Bank of Nasugbu in Batangas. The Bangko Sentral ng Pilipinas said problematic rural banks are the exemption rather than the rule, saying that the country's entire banking system remains generally sound and stable.
Previous research has focused on the nexus between economic growth and financial development, as well as the incentives of innovation for local financial institutions. Rapid innovations, as a phenomenon in the past decades, has changed the array of financial services available to customers, but at the same time, complicated the environment in which Central Bank or the Bangko Sentral ng Pilipinas implements its policies. This presentation tries to explore the impact of financial innovation and the capacity of the central bank to stabilize the economy and promote long-term economic growth.
Financial innovation in the Philippines. Financial innovation influences the structure of financial markets, the financial behavior of economic agents, and the types of financial products traded. It therefore influences the entire monetary transmission mechanism and adds uncertainty to the financial environment in which central bank conducts monetary operations. To deal with relevant issues, the monetary authorities normally react by introducing greater pragmatism in the implementation of policies and by strengthening the surveillance of banking activities. Let us now proceed with the financial innovations in the Philippines. As shown in this slide is a clipping from the article of former President Gloria Arroyo, spokesperson, Attorney Ignacio Bunye. According to the article, the financial innovations that were introduced in the Philippines can be divided into 3 episodes. The first one is the banking innovations prior to the 1990s. The second one, institutional changes in the 1990s classified into foreign exchange liberalization, financial liberalization, and the passage of the General Banking Law of 2000. And lastly, after the year 2000, the emergence of non-traditional banking products and services. In the attached clip study is the financial reform and development in the Philippines from 1980 to 1997, wherein the abstract of this study tackles the financial innovations. It was researched by Ponciano S. Intal Jr. and Gilberto M. Llanto. The abstract. The paper reviews the innovations developed by some financial institutions to meet the challenges of microfinance and rural finance markets. Innovations could be new products and methodologies or refinements to existing practices that are created in response to market inefficiencies in changing demands of a target client. Essentially, innovations by financing institutions are not only a means to reach the large unserved poor households, but also to provide more and better products and services that could contribute to increasing profitability of the institutions adopting them. The first type is innovations on the financial system, which refers to changes in the structure of the financial sector, particularly in the legal and regulatory framework. The second type of innovation is institutional innovation, which deals with the changes in the structure, organization, and legal form of the institution. Another type of innovation is the process innovation. This refers to the introduction of new business processes leading to increased efficiency or market expansion. The last type of innovation is products innovation, which refers to the introduction of new or modified products or services tailored to the needs of the rural borrowers. In addition to the clippings, there are three key principles behind innovations: knowing the market, using special techniques to slash administrative costs, and using special techniques to motivate repayments. Satisfying these key principles, innovations create additional value for borrowers and clients through a reduction in households and enterprises' transactions costs of access to financial services, lengthening term structures, thereby facilitating larger investments and improving clients' economy by refining valuation process on the part of the institution. Innovations can increase profitability by reducing costs or increasing revenues, and improving competitiveness by serving new segments or by generating additional income in its business with existing clients. Let's take a sample of financial innovation. The evolution of electronic means of payments, or to be precise, e-money, is inevitably one of the financial innovations that has a direct impact on the monetary transmission mechanism. The increasing use of this alternative form of money has the potential to substitute for traditional form of money. To the extreme, it could replace bank demand deposits and other types of highly liquid deposits, undermining the functioning of the monetary transmission mechanism, as the link between change in bank deposits and change in real sector activities is weakened. Moreover, the lesser demand for traditional form of money could lead to a reduction in the amount of reserves held by financial institutions with central bank. Technological advances in payment systems, which allow for a more efficient settlement of interbank transactions, also reduce the necessity of holding excess reserves with central bank for precautionary motives. Financial resources can then be relocated or reallocated to other sectors. Let's take another example: microfinance. As one of the fastest growing businesses, the Philippines microfinance sector is not only attracting interest and investment but also the world's admiration. Recently, the Economist Intelligence Unit, EIU, ranked the Philippines microfinance regulatory framework as the world's best, and the industry's performance second best in terms of overall business environment. As per the latest statistics released by the central bank, 203 institutions lent nearly $226 million to over 930,000 micro borrowers in 2010. Another is the bank assurance. In recent years, the central bank has received a number of applications to conduct bank assurance from both local and foreign banks. A 2007 report on the banking industry predicted that bank assurance would account for 65% of total insurance product sales by 2011. Mobile banking. Mobile communication is well entrenched in this market, with penetration nearing 80%. Analysis estimates that there will be 126 million mobile subscribers in 2015. 1 in the 8 will have an option for 3G services. There is a strong demand for mobile money services among the unbanked sections. As per different estimates the number of mobile banking users will rise to 11 million either this year or in the next year. Besides traditional banking players, telecom companies are also participating in this opportunity by offering several new services. The retail wealth management, with young investors showing interest in mutual funds and related products, retail investment advisory and wealth management services are showing signs of growth. Lastly, in this presentation, let us hear once more the statement of Governor Armando Tetangco Jr. In his statement in reference with the financial innovations and its impact for the Philippine banks to respond positively. And I quote, "I believe there is a place for financial innovation in market development. Its presence provides avenues to address varying risk requirements of investors and users of funds. What I always emphasize, however, is that embracing financial innovation must be coupled with appropriate prudential regulation, including appropriate disclosure and transparency standard." Unquote.